Joining me now is a very special guest. I've got with me Saion Mukherjee, Head of India Equity Research at Nomura. He's here on the back of the latest Nomura report on India and what is the index likely to do going forward, reading into the news flow that we have seen over the past few months. Saion, thanks very much for joining in. Now that we've got the budget out of the way, we have seen what the government is ready to do in regards to having its push to infrastructure, investment, their divestment target, which is stiff to say the least. But, how is the setup now as we step ahead?
Yeah, I think, from a budget perspective, we thought that there are two key, positives there, if you see. So firstly, I think it's been a positive budget from a perspective of cost of capital, right? The fact is that there seems to be a push towards attracting foreign capital, which is positive. Plus, the government has decided to adhere to the fiscal discipline. There was expectation that, there could be some kind of stimulus to stimulate growth. But the government has stuck to fiscal prudence. I think so. Overall, the environment for cost of capital coming down is very much there. So that's the first takeaway. And the second is that I think the government through the statements during the budget kind of made its intent clear around really focusing on the NBFC issue and the crisis, and the action by the government and RBI makes us believe that they're keeping a close eye on that and are willing to step in as and when required. I think that's quite crucial because I think you don't want to be in a situation where this escalates and have a very adverse impact on the broader economy, impacting the growth overall. So as a base case, what we are seeing is that we have a lower cost of capital. We expect transmission to happen of lower interest rates to the economy, and we are actually forecasting a gradual recovery in economic growth, particularly as we go towards the end of the year and early next calendar year. So that's the kind of broader construct that we are working with, and we believe that it kind of gives us an opportunity to build portfolio, to look at select stocks where there is a good amount of valuation comfort.
Okay, so since we are talking about the lowering of cost of funds, I believe the key beneficiaries would be those financial intermediaries. So should one start looking at them with the idea of having a bigger allocation to that medium?
Yeah, I think we are overweight on financials, and is our the top overweight sector in our portfolio. So I think financial intermediaries, the ones who are the beneficiary of lower cost of capital and who are in a position to get market share from the ones who are currently struggling. So I think it's a very good sweet spot for some of these financial intermediaries, and in some of them the valuations are not that expensive at this point. So therefore I think it makes sense to definitely look at the financial intermediaries at this point in time.
Okay, you've placed out a March 2020 Nifty target at 12,900. What are the key reasons behind this target?
So obviously there is a good amount of valuation support that we are getting from the fall in bond yields, right? And historically we have seen inverse correlation between the yields and the valuation multiple. So I think this, the fall in yields, and a low cost of capital environment does provide good support to the broader market valuations. So that's one of the drivers where, though there may be some risk to earnings in the near term, we don't see a material risk, but some risk you can't really ignore. But I think the good support from the lower yields is something which drives our market valuations. We are assigning 17 times 1 year forward, which is fiscal 21 earnings, to arrive at 12,900 target for the Nifty.
Do you see, foreign investors waiting Indian stocks on the higher side in benchmark indices. Do you see that happening now that the free float as well as foreign ownership limits have been upped?
I think, yeah, that's incremental positive, right? I think the outcome of lowering, we don't know actually the timeline, right? I think it's yet to work out. It's just a proposal by the government to lower the ownership and increase the free float. But let's say it happens over, let's say, 3 years or so. I think at the margin it helps because of increasing weights of Indian stocks in the benchmark indices. So I think as and when that happens, it would lead to higher inflows and interest by foreign investors.
Just the fact that even while you're talking about India being slightly more richly valued, you are also comfortable with a 17-time valuation. You've increased that from 16 times. Do you think that will be a deterrent, or foreign investors, keeping in mind the other opportunities that they're seeing in India, are ready to pay that?
See, the thing is that we also, when we kind of look at valuations, we also need to kind of, I think, look at where we are in the earnings cycle, right? As you know, like earnings has been disappointing, and there are multiple issues, which India and Indian corporates have to grapple with. So we are actually, unlike in many of the other markets, we are actually at what we think is on the lower end of the earnings cycle. So we are expecting earnings growth to revive from here on, and in that context, I think one could argue for relatively higher valuation multiples. I know like some of the other markets in the region, in terms of price earnings, multiple may be trading cheaper, but then the growth there is something which is lower than what we expect for the Indian corporates to deliver.
All right, got that point. The other one also is, since we were talking about that stiff divestment target that the government has put out for itself, now they're looking at the 6th CPSE ETF. Do you think there's enough appetite now in the market for this?
So I think we have to see how and when that kind of plays out. But yes, I think, as you know, the disinvestment target has been increased. I think one can expect some overhang on some of the government-owned stocks on back of this. But I think it's just a pocket which can potentially get impacted technically in the shorter term. But we see some of those names are quite attractively valued, so one may look at if there is any weakness in those names on back of this. And of course, and there could be other initiatives by the government to raise resources, which could be monetization of the other assets over and above selling the stake in listed entities.
What did you make out of the additional liquidity that they are going to be providing to the tune of 70,000 crores for some of the public sector banks, and also that special liquidity window for NBFCs? Is that enough, according to you?
See, I think the system would like that. I mean, of course, at the margin, providing liquidity or capital for growth is something which is definitely positive, I think. The thing is, how much of that really helps, because we have seen, let's say, the banking sector liquidity has been quite tight for some time till very recently when it has gone into surplus. But I think that's one necessary condition for transmission of related rates to happen. I think importantly, as I was mentioning at the start, that I think it kind of indicates, right, the Reserve Bank and the government really taking stock and looking at this issue and the problem that the sector is facing. I think that gives a good signal to the market, and the risk of a material slowdown if the issues are are left to linger on for a longer time. I think that risk stands reduced. So that's, I think, is the key takeaway from these initiatives that the government announced in the budget.
Two sectors witnessing some amount of negativity equity. One, obviously, the big push towards electric vehicles may weigh down heavy on some of the OEMs, and the other being the tax on buybacks, which had been the primary source of how most of the IT majors gave the excess cash back to shareholders. Some companies, in fact, have actually started withdrawing their buybacks. I'm not talking about the IT company, but some smaller companies that had announced buybacks have started to pull out as well. How do you see this weighing in individually on both these sectors?
So in autos, actually, we have gotten incrementally cautious, from where we were earlier. There was an argument. The stocks had corrected given the slowdown and earnings cut. But these were all well-run companies, cash-throwing companies. So there was a temptation to look at these names given the high cash flow yields some of these companies were trading at. But what we are seeing today is that the earnings cut are continuing, and in fact, when I look at the estimates today, I think there's a possibility of disappointment in earnings from where we are, and that's something which won't be supportive of the stock prices. And secondly, as you mentioned, structurally, the government seems to be quite determined to push electric vehicles. There are positives for India over the long term there, but it's inherently it's a disruption, and that's something very difficult to take a call on. I'm sure all these companies are aware of it and will be taking steps, but how the industry shapes out, let's say 4, 5, 6 years down the line is a very difficult call, and this uncertainty has the potential to drag down your valuation multiple in the near term. So we are kind of looking at a scenario where you do not have an earnings support, as well as the risks to the valuation multiples coming down. So putting both these together, we have taken a cautious and an underweight stance on autos. And on your second question on the tax on buyback, I think obviously it's incrementally negative. That's the way the companies were using to basically overcome the dividend tax that was imposed. I think for equity holders it's negative, right? It's just reduces their net return, and definitely it's a negative in general. But I think that's the policy the government has taken, and I think the stocks have factored that in now.
Okay, got that. Just one last question, Saion. Where are you most constructive on, with regards to the earnings potential, with regards to valuations not being all that expensive compared to its earnings potential, and some of the return ratios also seem fairly okay. So from that perspective, any space, any sector that you're relatively constructive on?
Yeah, I think, obviously financials is our most overweight sector. And, as we kind of discussed before, it's a sector which is going through a transition again, right? So there are high quality intermediaries who would be beneficiary of market share gain and lower cost of capital. And, some of these companies has the potential to surprise on earnings, and also there can be a valuation multiple re-rating that's possible in these names. The other sector where I think we have somewhat contrarian view is on the healthcare. We have seen significant erosion in earnings over the last 3-4 years because of multiple issues, primarily from the US. And I see a potential of a non-linear recovery in earnings. And given the pain that the sector has seen, I think the interest levels, ownership, cautiousness is just very high, and interest level and ownerships are very low, right? So I think the risk reward looks quite good. Expectations are low, so it's unlikely the stocks will fall a lot. But if some of the things that we are expecting plays out, you could have a support from earnings as well as from multiples moving higher.
All right, Saion, we leave it at that. Thank you so very much for joining us this afternoon.
Thank you very much.